So good morning, everyone, and you're welcome to our last class on Sunday, the extra class we have to enable us leverage on the syllabus. After today, this extra class will not be necessary anymore, so we can just stick to our usual timing to cover whatever outstanding that is left in the syllabus for the month of October. So welcome you again. Today, we're going to start with IAS 40 to finish up what was left of last week. Started a question, but events did not allow us to finish it up. And remember, speaking of IAS 40, I told you that they are majorly land and building. It could be just land. It could be just building alone. And it can even be part of a building. And what makes them an investment property is that they are held for income generation or capital appreciation. Whether you're holding it to collect rent or you're holding it for it to appreciate in value. You see, there's a thin line between investment property and owners occupied property, which is PPE. And the thin line is that PPE can also be land and building or part of a building. But what makes PPE is that it's basically held for either production or supply, or it's held for administrative purposes, or is held for other use. But investment property is majorly the land and building is held for income generation and capital appreciation. And I did some further breakdown. I did some further breakdown for you that investment property can be land that is held for primarily capital appreciation. That is a land that is just held vacant. You're not using it for anything. It's just there. That's an investment property. Or you have a building that you own, or a building that you even lease under a finance lease, and you now rent it out under an operating lease. That building is an investment property because you are holding it for rental income. Or you are a parent company and you decide to lease your building to a subsidiary under an operating lease. You see, in your own separate account as a parent, that building is an investment property, but in the group account, it cannot be an investment property because I already taught you that in consolidated accounts, you cannot generate income from members of the group. You cannot transact business between one another. It's invalid. It's against IFRS 10 because all intra-group transactions are cancelled out. So you cannot possibly then rent a building to a subsidiary. As far as we are concerned, that building will be seen as PPE. That building will be seen as it is being used for production of service or provision of service within the group. It can't be an investment property. And also, if you have a building that you are constructing for investment property, that will also qualify as an investment property. So we explained all of these last week. And we also went further to talk about partial use, where you have a building that has multiple components, and a component of the building is used for administrative purposes, that is, for owner-occupier, while another component is actually rented out. So are you going to classify such a building as an investment property, or you're going to classify it as PPE? IAS 40 states that if the separate components can be sold separately, if you can say, okay, well, this floor, you can sell it out separately. If that can be done in whatever way, then the parts that you're renting out, you can then classify that part as an investment property. While the parts that you're using for administrative purposes, you can classify that as PPE. However, if the component cannot be sold separately, then the classification as to whether it is PPE or investment property should be based on significance of use. If the portion that is rented out is deemed as the significant portion, then you're going to classify the entire building as an investment property and vice versa. That is, if the portion that you're using as administrative purpose is the portion that is significant, then you're going to classify the entire building as PPE. And when we say significance of use, we're talking about the portion that you believe is used more for a particular purpose. The standard allows you to determine that yourself using your judgment. They allow management judgments to determine significance of use. Additionally, we talked about ancillary services, that where you have a building and you are the one that provide the residents of that building with water, security, electricity, and other amenities on the building, then that is ancillary services. If the ancillary service is significant, if it is major, then the building is classified as PP. If it is not significant, the building is classified as investment property. How do you know that an ancillary service is significant? The standard says use your judgment. You should know whether it's significant or not. And of course, that will be part of your disclosures you're going to make, the notes to the account. But there are some that are obvious. Like if you own a hotel, the ancillary service there is significant. So if you own an hotel, that hotel is clearly PPE because the provision of ancillary services is significant. You provide them everything. You just pay. You just pay. While some you will need to think through it, you will need to make it an issue of policy that since you are the one providing security, water, then we believe is significant. You see, there are some gated estates where you pay service charge per annum, and they are the one in charge of your security, they are the one in charge of your electricity, water, and all of that. Why in some cases, all you pay for is just security. They are the one that will take care of everything, right? So, I mean, the standard allows judgment. You just need to explain to the auditors and your users the basis of your judgment. Having established that a building or a land is an investment property, you can only recognize this if it will generate inflow of economic benefits and if it has a cost that can be measured reliably. When you want to measure an investment property, it is initially measured at cost. and it is subsequently measured either using the cost model or fair value model. The cost model is costs minus accumulated depreciation minus accumulated impairment losses. Fair value model is simply fair value, which goes to show that when you measure an investment property at or using fair value model, depreciation will not occur. You will not depreciate that asset because it's simply measured at its fair value. And when an investment property is measured using fair value model, any change in fair value will be recognized to P&L. This is quite different from the principles in revaluation model, where changes in revaluation or revalued amount are recognized to other comprehensive income. Here, for fair value model, the changes in fair valuation are recognized to P&L. After the correction last week, which was where we stopped. Correction says that business owns a building which it has been using as head office. In order to reduce costs, in 30th June 2019, it moved its head office function to one of its production centers and is now letting out its head office. Its company policy is to use the fair value model for investment property. Building had an original cost on 4th January 2010 of 250,000 and was being depreciated over 50 years. At 34th December 2019, its fair value was judged to 350,000. How would this appear in the statement at 34th December 2019? So we're trying to what we're talking about, because when you it's that business owns a building which it has been using as head office. And in June 2019, it moved its head office function to one of its production center and is now letting out its head office. So what happened here is what we call change in use. A building that had head office before. Now, hello?
We can hear you now.
Yes, sir, we can. I can hear you.
Okay, good. So as I was saying, so the building is the building will be reclassified from PP to investment property because we're using the building for office. At that point, it's PP. But now, we are not using it, we are not letting it out. It becomes an investment property. Then how are we going to do this in our financial statement as at December? At what value are we going to put it in our books? Okay, so we need to establish the value of the building as at when there was a change in use. And the change in use occurred in 30th June 2019. So the building was PP from 1st of January 2010 to 30th June 2019. This is 9.5 years. And we need to then get what's the carrying amount as at 30th June 2019. The carrying amount is going to be cost of the building, which we're told was acquired for 250,000 on 4th January 2010 minus accumulated depreciation, which is 250,000. What's the useful life of the building?
50 years.
50 times how many years up to June? 9.5 years.
years. Yes. So it is 47,500.
47,500.
500.
Okay, when you take 47,500 away from 250,000, you should be looking at 202,500, which is as at June 2019. Now, as at 31st December 2019, the building is now investment property. But before then, they did the evaluation of the building, and the value was 350,000. That means that as of December, in our statement of financial position, what we show as the value of the investment property is 350,000. However, the asset used to be 202,500 in our books before the valuation. So there is a surplus. There's a revaluation surplus here of how much? What's the difference between the two?
It is 147,500. 147,500.
147,500. Now, this 147,500, where is it going to go? Where will it be recognized?
OCI.
Profit and loss. Profit and loss.
POL, sir. Profit or loss, sir.
Other compensation.
Okay, good. So some parties should go to PL, while some parties said they should go to OC. So let's seems okay, so let's start with the people that said OCI. I think Ufoma said OCI. Ufoma, let me hear from you. Why do you say this surplus should go to OCI?
Hello, sir.
Yeah, I'm with you, Ufoma.
Because it's fair valued, it's not being sold yet.
Is fair valued, is not being sold yet. No, if that's the reason you're taking it to OCI, don't forget what I taught you, that when an investment property is measured using fair value model, any changes in fair value should be recognized to P&L. So it's not a matter of whether it's been sold. It's about understanding the treatment of changes in fair value under fair value model, changes in fair value under evaluation model. Any changes in fair value under evaluation model, that change, that gain or loss would go to OCI, but under fair value model, it goes to PL. So your reasons for going for OCI is not acceptable. I'm not saying you're wrong, but I'm saying your reason is not acceptable. So let's hear from those that said you should go to PL. Why should it go to PRL? Michael.
Good morning, sir.
How are
Okay,
you?
fine, sir. Yes, sir. As it is, that's the standard. Any revaluation surplus should go to P&L, sir. That's the standard, sir. That's what the standard says, sir.
Which standard is that?
Can I consider?
Yes, please. Fine.
I think the property is being used as PPE before. So any revaluation there should go to OCI. But now we are changing, there's change in use. So since there's change in use, the fair value will now go to profit or loss.
Good. So your own explanation is much
Because
clearer.
there's changing.
Yes. Very good. Good explanation from you. So he understands it very well. He said that the asset used to be PPE before, and PPE under IAS 16, that uses revaluation model. And for evaluation model, any changes in fair value will go to OCI. He now said that, but now there is a change in use. The asset is no longer PPE anymore. It is now investment property. And for investment property, we use fair value model. And under fair value model, any changes in fair value goes to P&L. That was his response, and that shows understanding. But it's wrong. Even though his explanation is apt, but it's wrong. This is going to go to OCI. This is going to go to OCI. And the only reason is this. Whenever there is a change in use.
Yes, we can.
Yes, sir.
We can hear you, sir.
Loud and clear, sir.
Okay, good. So I said that whenever there is a change in use, any revaluation surplus that is arised or that is made when there is a change in use, that surplus is going to be treated based on the old use. That surplus will be treated based on the old use. So in this case, there is a change in use from PPE to investment property. We now measured these assets at the date of change. So you cannot possibly then treat this gain based on the new use, based on the fact that, okay, fair value model says any changes in fair value should go to P&L. No, you cannot treat that surplus based on the new use. You treat it based on the old use, which is based on PPE, which aligns with that when you revalue a PPE, any changes in revaluation goes to OCI. So at the date of change in use, any gain or loss will be based on the old use and the reasoning makes sense. This gain cannot possibly arise as a result of the asset being investment property. No, this asset had been PPE for over 9 years. So this gain is as a result of it, as a result of that old use, not the new use. So, however, maybe next year now, next year, that it is now investment property. Maybe next year, they now remeasured it again from 350 to, let's say, 400. That gain then can then be treated as gain under investment property. Then that gain can go to P&L. That gain can go to P&L. But you see, that very first remeasurement, that very first surplus you're making, it should be based on the old use. Because you cannot possibly attribute it to the new use. That one is just coming in. You attribute it to the old use, and that's the only reason why this one for the 7,500 will be recognized to OCI in line with the old use, just to honor the guy that this asset has been in PPE for 9.5 years. So any gain, any surplus made on revaluation as at that date, as at that period, let's attribute it to this old use. Then subsequently, whatever gain we then make going forward can then be attributed to the new asset being investment property. So this is going to go to OCI. Now, there are some things you need to note. Note the following for change in use. This is extremely important for every one of you. I've seen it severally in your exams. So, you see, when there is a change in use, note the following for change in use. So, if a PP is changed to investment property, that is measured at costs. The new value that is made, let me not say at costs. That's very wrong of me to say. That is measured using cost model. Is it that cost model or fair value model? So the new value of the investment property will be the carrying amount of the PPA at the date of change in use. What I'm saying is this, if an asset that was PPE before, let's say the value of that PPE was 100,000, the carrying amount is 100,000. You now change it to investment property in, let's say, December of that year, and you have decided to measure that investment property using cost model. Then the question is, at what value are you going to carry that investment property? It will be at the carrying amount, it will be at the 100,000, at the carrying amount of that PPA at the date of change in use. Whatever the amount is, that will be the new value of the investment property. But if a PPA is changed to investment property, an investment property that is measured using fair value model, you see, in this case, the new value of the investment property will be the revalued amount, of the PPE at the date of change in use. And any surplus thereof, meaning from that evaluation, will be treated to OCI, meaning as in its position as PPE. And this second scenario is exactly what happened here. They changed a PPE to investment property that is measured at fair value model. The new value of that investment property cannot be this carrying amount, cannot be 202. They have to remeasure that PPE. That was why they gave you the fair value. They must. That's the requirement of the standard. If you are changing use, and that new use, that investment property will be measured at fair value model, you have to revalue that asset at the date of change in use. And it makes sense. Since it's fair value model you want to use, it's expected that you go and fair value it, right? And any surplus thereof will be treated based on the old use. Will be treated based on the old use. So this will be recognized in OCI. So I really need you to be careful of this. Now, there's another question.
A question on that question that we saw, sir.
Yes, please. Yes.
Okay.
Yeah,
Yes. The property was converted on June 2019, and that was why we stopped the depreciation at 9.5 years. So when it
yes.
becomes an investment property for that 6 months, we still did not consider anything on that investment, but we still charge everything as OCI to evaluation support. And so that 6 months where it has been converted, so does it mean the investment did not gain anything at all?
Good question, Lukman. Good question. So it might have gained, it might not. But as it is, the question didn't, they just told us that as at December, the value is now 350. Probably they use that period to do their evaluation. But one thing we know is that from that June, when there was change in use, and the question told us that it becomes investment property under fair value model, we don't depreciate investment property that is measured using fair value model. So we wouldn't be expected to do any further depreciation beyond that date. However, since the investment property will be measured under fair value model, it has to be remeasured. It has to be remeasured. And the first remeasurement, whenever, even if you did not remeasure it until after 1 year, whenever that first surplus at the date after it becomes a new class of assets, you have to treat that surplus based on the old use. Based on the old use. And the thing is that, it's vice versa in the sense that if it was an investment property before, it is now changed to PP. And that PP or that investment property is measured at fair value. You now did that remeasurement at the date of change in use, or after the change in use, you remeasured the asset. That first surplus will be treated based on the old use, which is investment property. If the old use was investment property, that means whatever gain or loss that was determined at the date of change in use or on the first revaluation after change in use will be treated to P&L. Since the assets used to be investment property, that first one, we believe is as a result of it being the old use. So that lag period you're talking about, Lukman, between June and December, that actually at that time it was already investment property. Wouldn't the asset have made any gain during that period? It might have made gain, but we're still going to attribute it being PP. Because revaluation is not something they just do immediately. It is not a one-day event. It takes time. It takes time that, okay, this asset wants to become this new class. Okay, let's get the new value. Mostly you engage an expert, they will do documentation, they will go out. It can take a year, it can take months. It can take months. So you are still attributing it to the old use, not the new use. Then going forward, you can then be treating it based on whatever it is at that point in time going forward. I hope that is clear.
Yes, sir. Thank you very much.
You're welcome. So let's look at this question. It was for 8 marks. They said that if a property is transferred into or out of the category of PP, they said it might be reclassified as investment property or as no longer an investment property. And I said a transfer of investment property can only be made where there is a change in use or change of use of such property. And I said required, identify 4 circumstances that may lead to recognition or derecognition of an investment property under IAS 40 and state the appropriate accounting treatment under each circumstance. Okay, fantastic. Now, if you look at this question, it's similar to what I just finished explaining to you. We're told that identify 4 circumstances that may lead to recognition or derecognition. So if I can get 2 circumstances for recognition and 2 circumstances for derecognition, I would get 4 marks. Then also stating the appropriate accounting treatments, I will get additional 4 marks. So let me do recognition. So the following circumstances can result to recognition of an investment property. Number 1 is acquisition of an investment property. So this is treated as this is measured, let me say measured. This is measured at costs on initial recognition, and at the end of each year, it can either be measured, using the cost model or valuation model. Number 2, can say transfer from property, plant, and equipment
Hello, sir.
to...
Is it fair value method?
Oh, thank you, Jerry. Thank you. Fair value model, now evaluation. Number 2, transfer from PP to investment property. So if the investment property is measured at cost model, it will be measured initially at the carrying amount of the PP at the date of change in use. Or let me use the way they mentioned it. It's a change of use. However, if the investment property is measured at fair value model, it will be measured initially at the valued amount of the PP at the date of change in use. I've mentioned two. Second one is, let me do the recognition. The following circumstances can result to the recognition of an investment property. Number one, transfer from investment property to property, plant, and equipment. So, if the PPE is measured at cost model, the PPE is measured at cost model, the PPE will be initially measured at the carrying amount of the investment property and the date of change of use. However, if the PP is measured at evaluation model, it will be measured initially at the fair value of the investment property at the date of change in use. Also, we can do transfer from investment property to inventory, where this occur, the inventory will be measured at the fair value of the investment property at the date of, not the investment property, at the fair value of the inventory at the date of the change in use. Because if I want to analyze all of this, for the first one, when you just buy an investment property newly, so you measure it at cost, then at the end of each year, you can measure it using cost model or fair value model. Or you can transfer from PP to then become investment property. You see, the way you measure the investment property, it depends on your choice of measurement. If you choose to measure the investment property at cost model, then fine, whatever it is that was the carrying amount of the PPE, however you measure the PPE does not matter. Whatever it is that was the book value of that PPE becomes how you're going to measure that investment property. But If the investment property, if you choose that you want to measure it at fair value model, then you would have to remeasure or revalue the PPE at the date of change in use. You need to make a decision to remeasure it because that investment property is going to be measured at the revalued amount of that PPE. But if you want to derecognize, that is moving away from investment property to PPE. Then in that case now, that means the focus then becomes on the PPE. How do you then measure the PPE going forward? If you choose to measure it at cost model, then whatever it is, that was the carrying amount of that investment property at the date of change in use becomes the value of that PPE. But if the PPE is measured at the value model, that means you will need to revalue that investment property at the date of change in use. Whatever that value is becomes the value of that investment property, of that PPE. But if you are transferring from investment property to inventory, that one, you would measure it at the selling price, at the fair value of the inventory. Is how much do we sell it? That's how you're going to measure it. And in this case, any change in fair value will be recognized to PL. Be recognized to PL. That was for 8 marks, so it's not trivial. It's a lot. Now, another question. This one says that Young shall go limited with year end of December 31st purchased an office building with a useful life of 50 years for 55 million on January 1st, 2013. The amount attributable to land was negligible. The company used the building as its head office until December 31st, 2017, when the entity moved its head office to a larger premises. The building was classified as an investment property and leased out under a 5-year lease. However, owing to a change in circumstances, Young shall go limited to possession of the building 5 years later, on December 31st, 2022, to use it as its head office once more. At that date, the remaining useful life of the buildings was confirmed as 40 years. The fair value of the head office was as follows. At December 31st, 2017, it was 60 million. At December 31st, 2022, it was 75 million required. Discuss how the change of use should be reflected in the financial statement of Young Shago Limited. 1, if the company uses cost model for its investment properties. 2, if the company uses fair value model for its property. Okay, how do we address this? If you look at the question, we are changing use. So the end is December 31st, right? He bought a building in 2013, on January 1st. The building has 50 years. It costs 50 million. Now, they were using it as head office, meaning it was PPE, until December 2017. That's for 5 years, 13, 14, 15, 16, 17. So they decided to move the head office
I've lost audio, sir.
That okay, I want to start using it as PPE back. I want to use it I want to start using it as my head office again. It's okay. Now, I mean, 10 years is gone. Oh. For 5 years, he used it as PPE, he changed to investment property. Another 5 years, he used it as investment property. Now he's changing back to PPE. So useful life is now 40 years. But during those intervening period, when at the date of change in use, at the first date of change in use, the fair value of the building was 60 million. At the second change in use from investment property back to building, it's now 75 million. So we're now asked to discuss how the change in use will be reflected in the financial statement. So they didn't even say prepare, they said discuss. Now, let's look at I. If the company, just copy and paste. If the company uses the cost model for investment property, so see IAS 40 on investment property requires that where an investment property is measured at cost model and there is a change of use. The new classification should be measured at the carrying amount of the old classification. From the question, at 31st December 2017, there was a change in use. There was a change in use from property, plant and equipment to investment property. Since the investment property is measured at cost model, it will be measured at the carrying amount of the PPA at the date of change of use, which is 31st December 2017. And this is calculated as below. So what was the cost of the assets as at when we bought it?
55 million.
55 million. Minus accumulated depreciation, which is 55 million, divided by, what's the useful life? 50 years. So the useful life is 50 times How many years? 2013 to
5.
2000.
5 years.
Okay. So how much is that? How much is that?
That's 5.5 million.
Okay. So what's the carrying amount? Should be
49.5.
okay. So we're going to measure the investment property at 49,500. Furthermore, at 31st December 2022, there was a change of use from investment property to property, plant, and equipment. So since the investment property is measured at cost model, it will be measured and the carrying amount of the investment property at the date of change of use, which is 31st December 2022. And this is calculated as below. What was the carrying amount from the last change of use?
49.5.
Accumulated depreciation, which is last value divided by what now? What was the remaining useful life at that date?
The remaining share will be 40 years. Another 5 years have gone.
No.
For
45 years.
45.
Yes, 45. Because I want to get accumulated depreciation from 2017 to 2022. From 2017 to 2022. That's what I want to get. So, and during those period, I would measure it. So, and that's for how many years now? Times 5. So what would that give us?
5,500.
Again. So what's the difference? What's the carrying amount?
44,000.
44,000. Now, the second one. Yeah, I'm sure.
Hello, sir.
Yeah, please go ahead.
But you said we don't depreciate an investment property. Why are we depreciating this?
Oh, yeah, we don't depreciate investment property that is measured at fair value. The one that is measured using cost model, we usually depreciate that. So when you use cost model, it's costs minus accumulated depreciation minus accumulated impairment losses. Okay. Hello, can you hear me?
Yes, sir. Thank you.
Okay. All right. So the second scenario, which is if the fair value is used, if the fair value of if the company uses fair value model. So in this case now, let's slow down. So in line with IAS 40 on investment property, where an investment property is measured using fair value model, any change of use should be measured at the revalued amount of the old use. So from the question, at 31st December 2017, at 31st December 2017, there was a change in use from PPE to investment property. Since the investment property is measured at fair value model, the new classification or the investment property will be measured at the fair value at the date of change in use. And this is given in the question as how much? 60 million. 60 million. And any evaluation surplus, will be recognized to who can tell me? Will it be recognized to P or L or C?
OCI.
That's correct. Based on the old use. So OCI. So this surplus can be calculated as below. So what's the carrying amount at 31st December 2017? We computed it earlier, so we don't need to compute it again. It's 49.5. What's the fair value?
60.
What's the difference?
Yeah.
25. Second one. So at 31st December 2017, the change in use or the change of use from 22. The change of use from investment property to property, plants, and equipment will be measured fair value as well. And this fair value is given in question as how much? 75 million. 75 million. With the changes in fair value, recognize to where? Can you tell me? P&L or
Profit
OCI?
or loss.
Profit or loss. Right. So this surplus can be calculated as below. So what was the fair value when it was investment property at 31st December 2017? It was 60 million. And you know that when you measure it at, when it was 60 million, when we changed from PP to investment property in 2017, and we fair value it to 60 million, you won't depreciate. It will remain 60 million till December 2022. So they now fair valued it again at 31st December 2022. They fair valued it to 75 million. This fair value surplus also, we're going to recognize it to PIL, and it's 15,000. Okay. Uh, okay. So, Ufama, I don't understand your question.
Hello, sir.
Hello, Ufama.
So I was saying in IAS 16, when you use a revaluation model, does it still imply that we will not depreciate it?
No, we depreciate under IAS 16. We depreciate, so we depreciate it.
Okay,
It's,
sir. Thank you.
it's just fair value model that we don't depreciate. Okay, so let's quickly look at government grants. This is also a very short standard. Let me just explain the principles to you. So, I think let me start from government assistance. Everybody here knows what government is, whether state government, local governments or federal governments. That is government. So there's something we call government assistance. So is any action by the government to provide economic benefits to entities. So maybe they will have a criteria for giving it to them, but any action. And that action would involve providing benefits to them, whether monetary or non-monetary, but that's government assistance. And of course, there are a lot of government assistance available even in Nigeria, even though most of them are now being removed right now. But I mean, like the first subsidy we used to have before now. I mean, in Lagos State, for example, there was a time where they had to reduce fare for those that want to commute using BRT. And any action by government, or probably during COVID period, or probably maybe the government decide to provide training for people, government assistance. There are a lot of it. So then let's now come down to government grants. So you see, government grant is also a government assistance. Okay, so government grant is under government assistance. Okay, but however, this one is majorly to provide economic resources. So this is usually monetary. It's usually something that we can measure. That's what makes it a grant. Is assistance fine? But this particular assistance is to provide economic resources to entities, and these resources is in return for past or present action or let me call it conditions that has been met by those entities. So it's usually to compensate them for conditions they have met, right? That's government grants. So government assistance is government grants plus other actions by government. Okay, but government grant is just part of us. It can be, is under assistance, but it's very monetary. They are specifically providing resources to entities for meeting present or past conditions that have been specified by the government. I mean, there was a time during the past administration where the government was giving farmers, they called it Anchor Borrowers Program. We're giving them monetary seedling and all of that. That's a government grant. And we have seen on national TV where the government will buy tractors. It was part of the Anchor Borrowers Program where they give them assets. But it's not just anybody that will get it. There will be conditions attached to them. It's really those that meet that condition that will get those resources. And I mean, government can give, like BOI, for example, now. They would give interest, sometimes a reduced interest loan, that you can get a loan, but at a reduced interest. There's a grant, that's a grant, not the entire loan, no, but the interest savings there is a grant. Those are government grants. So basically, the full name of this standard is accounting for government grants and disclosure of government systems. So government grant is the one we recognize in our books. We do not recognize government assistance, any other one, because those ones are they are non-monetary. It's like maybe the government is providing technical advice or they are helping with marketing, something like that. You only disclose them. It's government grant that you recognize. So before you can recognize government grants in the books, recognition of government grants. So before you can recognize it, the entity, in fact, let me say there must be reasonable assurance that the entity will meet the conditions attached to the grant. So you have to be sure that you meet, before you're going to recognize it in the books as a grant, we need to be sure that you will meet the condition. If you will not meet the conditions, don't bother putting it in your books. Number two, there must also be reasonable assurance that the entity, will receive the grant. So these two are what needs to be met before you can recognize government grants in our books. Okay, you see, government assistance are not recognized in the books, but only disclosed in the notes to the financial statements. That's for government assistance. So how do you then recognize it? How do you measure? Measurement of government grants. Now, the measurement of government grants depends on the types of grants you're looking at. So the measurement of government grants depends on the types of grants. So what are then the types of grants? Types of government grants. Number one is grant related to assets. Number two is grants related to income. We have grants related to assets and grants related to income. So let's take it one by one, which is the grants related to assets. Grants related to assets. So this is a government grant. This is a government grant where the condition is that an entity must acquire an asset, and the government then subsidize the amount or the cost of the assets. Can also be a situation where the government transfers an asset to an entity. So the government can just give them an asset. Now, okay, take this asset. That's government. That's a grant related to assets. So how do you measure it? This is measured in any of the following ways. Number one is either you deduct the grant from the carrying amount or cost of the assets. Number two, you can also set up the grants as a deferred income. That's for grant related to assets. These are the ways you can measure it. Is either you'd deduct the grant that you collected, deduct it from the carrying amount of the assets, or you would you treat it as you set it up as a deferred income. Either one is fine. And we have grant related to income. So this is a government grant that is not related to assets. So any grant that is not related to assets is definitely related to income. And this is measured in any of the following ways. Number one, you present it as a separate line item in P&L. Number two, you net off against the related, you net it off against the related costs. So that's grant related to income. So it's either you present it as a separate line item in your P&L, or you net it off against a related cost. Now let's solve questions. This one says that a company receives 20% grant towards the cost of a new item of machinery, which costs 100,000. The machinery has an expected life of 4 years and a nil residual value. The expected profits of the company before accounting for depreciation on the new machine or the grant amount to 50,000 per annum in each year of the machinery's life. So we're now required to show the accounting treatment for the grant received. Now, you see, this is a grant related to asset. And it can be treated in two ways. Any way is okay. So the first way is deduct the grants and the cost of the assets. So let's treat it like that. In that case, cost of the assets for us will now be 100,000 minus the grant of 20,000. So the cost of the assets will now be 80,000. So in that case, the depreciation per annum on the assets will be 80,000 divided by what's the useful life? 4 years. And that is 20,000 per annum. And that's it. That's it. So who can tell me, anybody in this class, if you're deducting this grant from the cost of the assets, what double entry are we using here? Who can try? What journal must have been passed to do this? Anyone?
Sir,
Yes.
we will credit grant account and will debit asset account to the tune of 20,000, sir.
Oh, no.
So
No.
you credit PP
Mm-hmm.
and debit the grants.
Can I try?
Yes, try, Emmanuel.
Okay. Let's assume the 20% grant was sent to the bank account in cash to the bank account. So, for me, I would recognize the full cost of the asset first by debiting the asset and maybe crediting the bank where this asset was paid for. No, wait, hold on. Hold on. Okay, we'll credit the PPE, debit the bank where this payment for this grant was made for. Then we debit PPE with 80,000 naira and credit bank with 80,000 naira.
Wrong. I'm listening.
Okay, so let me try.
Okay.
We're going to credit the 20,000 to the cost of the assets. And then the other leg will go to the grant.
Somebody has said that before. If it goes to the grants, where? Is it P&L or where? Okay. Let's hear from Michael.
Yes, sir. I think we credit P&L.
Hello, sir.
Hello, Sama.
Okay, so the cost of the entire PPE is 100,000. So that will be debited to the class of the assets as 100,000. Then the proportion will be splitted into 80 and 20 respectively. A deferred revenue of grants 20,000 and probably bank for 80,000.
No.
Hello, sir. Let me try again.
Okay.
You credit the assets 20,000, then you debit POL, government subsidy.
Okay, I say it again, please.
I said you credit the assets 20,000, then
Okay.
the debit goes to POL, government subsidy account.
When you debit P&L, that's expense now.
Yes, that is. I will call it subsidy. That's the name I'm calling it at all.
Debit, you want to
Can
debit
I try,
again,
sir?
again. That means yes, I'm on me, try.
Okay, I'll debit the asset with the 20,000 naira grant, and then maybe credit bank with 100,000, which is the cost of the asset. So, but there'll be a second leg. I also credit grant account with the 20,000. That's the one received from the government. So I don't know if that works.
Say it again,
Sir,
sorry. I didn't
sir,
hear you.
sir.
The mic
Okay, I
erosion.
said,
Go ahead.
okay,
Go
can you hear me? Okay, I said I would debit the assets with 100,000. That would be like maybe the initial recognition for me. Debit that asset, then I will credit bank where the payment for the asset is coming from with the 100,000. Then debit the bank with 20,000 naira, which is the grant, and then maybe credit defer income with that for that 20,000. That's another approach I'm looking at.
Okay. All of those approaches are wrong. Okay. Let's go to Michael.
Okay, sir. I'll credit grant account with 20,000. Then the cost of assets also, as in asset accounts and PPE. I also credit PPE with 80,000 naira. So two of them makes 100. Then I will now go and debit with the tune of 100,000. Which account will I debit? Oh, okay. So I will now go and debit at machinery account with 100,000, sir.
Wrong.
Let me try, sir. Since
Okay.
the grant has been received, so the bank will be debited with 20,000.
Okay.
The grant account will be credited with 20,000. Then to remove that grant from our book, so the grant will also go to the assets as credit to reduce the value of that asset to 80,000. Then
No. How do you want to do that again? You want to enter you say you debit bank? Yes. You say you credit grants?
20,000.
You not credit asset again. How?
We'll now have to reduce that asset with the grant to 80,000. That's the PP.
What double entry will now use for that?
That's where I'm fixed now.
Yeah, the only one that was very close. You tried, but you didn't finish up well. Any other trial before I tell you the answer? Okay, you're supposed to debit bank credit assets. That's it. With 20,000. The assets, you already bought the assets. The asset is not the problem here. The asset was in your books. It cost you 100,000. So that's not the issue. The issue is the grant that the government wants to give you. You're going to, they say he receives. So the government actually gave him 20K. So it's debiting bank and crediting the assets. So the grant to not, it won't even go to P&L at all. I thank God I didn't even assume that you know it. Debit bank, 20,000. Credit the assets, 20,000, not income. So when you're deducting it, the grant from the costs, it's not income anymore. You are saying don't treat it as income. Go and treat it as a deduction from the cost. So credit, instead of this credit is what will have credited to P&L, right, as income. But we say no, use it to net off our costs, deduct it from the cost of the asset. So you credit the asset. And since we are receiving the grants, it's bank. Even if they have not given it to us, that we have not received it in money, what you are debiting is grant receivable account. Grant receivable as an asset. So this is how it will be recognized. And that is all you do. As far as if you are using it to deduct the cost of your assets. So just that this approach, yes, IAS 20 said we should use it, but I mean, it's crossing the line of IAS 16. IAS 16 will not like this because IAS 16 didn't provide for deducting grants from costs. It didn't provide for that. So, yeah, I mean, to a large extent, that means there's no handshake between IAS 20 and IAS 16, but I mean, it is what it is. If you get a grant, IAS 16, IAS 20 allows you deduct it from the cost, right? That's an option. Another option is you set up the grant as a deferred income. So in this case now, the grant received will be recognized as a deferred income. This is recognized as below. You debit bank because you are receiving it. You credit deferred income. There's a liability. So in this case now, this number 2 is better. It's better in the sense that your asset value still remains your asset value. Yes, government is giving you a grant, but we are saying set it up as a deferred income under liability. So that means your depreciation is still showing what it should be, 25,000 per annum. And IAS 16 is happy because you have not tampered with the cost of the assets. Unlike this one that is reducing the cost. This one didn't tamper with the cost. You see, what I think should be going through your mind is that why are we recognizing this as a liability? Why not straight to income for that year? Why not? So the reason is that, I mean, the condition is that you need to buy an asset, and since the asset will be used for 4 years, so we don't expect that you just recognize the grant down to P&L in the first year. We expect you to recognize the grant also as income over that same period for which you will use the assets, meaning over 4 years as well. So that means in this case now, the grants will be recognized to P&L, systematically over 4 years to align with how the asset is used. Okay. So you see, this systematically will now depend on how you're depreciating the asset. If you are depreciating the asset on a straight line basis, that means you are going to recognize this grant as income on a straight line basis. If you are recognizing depreciation on the assets on a reducing balance basis, that means you are going to recognize this grant to income on a reducing balance basis. So, you see, the way it works is this. In my P&L statement, in my statement of profit or loss, so I will have depreciation, expense, 25,000. I'll have grant income. That will be 5,000. In my statement of financial position now, under my non-current liabilities, I will have deferred income, 15,000. Let's assume this is year 1. In year 2, your depreciation still remains 25,000. You recognize another grant. In that case now, your deferred becomes 10. In year 3 now, depreciation this one becomes 5. In year 4, depreciation, this one becomes 0. You see that step 1 or approach 1 is very easy. Just deduct it from the grant, and that is all. Debit, bank, credit, that is all. But approach 2 is preferred, but it requires more effort from you, because you need to then systematically recognize the grants every year over the useful life of the asset. The same way in which you are depreciating the asset is the same way in which you are going to recognize the grant. If you are depreciating the asset equally, you recognize the grant equally. If you're depreciating the asset on a reducing balance basis, you recognize the grant to P&L on a reducing balance basis, like that. So it's more tasking like that. And you now be reducing the deferred income gradually. So you see, that means that I'm done with this question. I just want to use this question to divert a little bit. Okay, so I want to use this opportunity to talk about repayment of government grants. Can something like this arise? Can the government ask you to come and repay? Of course, yes, because there's always condition attached to a grant. And if you don't meet those conditions, they will ask you to bring back the money. And that is why this issue of liability makes sense. Because if these assets, you didn't use it for the purpose for which you're supposed to use it for, they can ask you to return their money. They can ask you. So in such cases, you would have to, you would treat the grants, or you treat the repayments of government grants. It's like a change in accounting estimate. So it's like estimate will change because values will change. The estimate you have made will change. So let's say in year 2 now, from this correction, the government say, give us our money back, meet the condition. The best can do is to recognize this different. Okay, so yeah, back. I am back. So this is recognized by setting off the repayment against the deferred income balance, depending on what they ask you to pay. Okay, so any balance can be transferred to P&L. So even year 2 now, the government says, oh yeah, return our money. The deferred income balance you have is 10,000. So, and let's say they say return 15,000. So when you credit, you give them 15,000 out of your bank, you can only debit 10,000 to deferred income. Do you know where the remaining debit will go? The remaining 5,000.
Profit or loss?
Thank you very much. P&L, expense. You expense it, so which makes sense. It's just net off these 5,000 here in P&L, but it goes to profit or loss. But what you need to note for payment for government grant is like estimate is changing from whatever it is to 0, right? And you then need to, what you're doing is you're setting up the repayments against any deferred income balance. Any deferred income balance, and any balance thereof can be transferred to PR. Okay, let's look at another question. So for this one, they say that the federal government of Nigeria is committed to improving medium, small, and micro enterprise program. In view of this, the government issued directives to the CBN to give grants to MSMEs that has at least 25% local equity participation required. Explain the 2 types of government grants or assistance that are recognized in IAS 20 on accounting for government grant and disclosure of government assistance. Outline the 2 methods of presenting grants or government assistance that are recognized by IAS 20. Okay, so they are explained there's grant related to assets and grant related to income. Grant related to assets is where the condition attaches that the entity must buy an asset or the government outrightly gives the company an asset. While grant related to income is any grant that is not a grant related to assets, is a grant related to income. And the 2 methods for presenting government grant or assistance it depends on the types of grant. For grant related to assets, you present it either by deducting the grant from the cost of the assets, or you would you set it up as a deferred income. And if it's a grant related to income, is either you present the grant as a separate line item in P&L as an income, or you net it off against related costs. Then the B part states that during the year ended June 30th, 2019, Gbogbo Nishe Enterprises, having qualified for the 25% local equity participation, received the following grant from CBN. On September 1st, 2018, a grant of 1 million was received from CBN. The grant was in respect of training casual workers. The training cost incurred by Gbogbo Nishe Enterprises in this respect was 1.75 million. On November 1st, 2018, Gbogbo Nishe Enterprises acquired plant and equipment costing 8.75 million and received a grant of 2.5 million from Central Bank of Nigeria in respect of the purchase. The plant and equipment, which has a residual value of 1.25 million, is depreciated on the straight line basis over its useful life of 5 years. On June 1st, 2019, a grant of 2.5 million was made by CBN. The grant was in respect of relocation costs that Gbogbo Nishe Enterprises had incurred for movement of its business to a free trade zone allocated to medium, small, and micro enterprises. The grant is repayable in full unless Gbogbo Nishe Enterprises recruit at least 100 employees from the free trade zone local area by the end of the month of June 2019. Gbogbo Nishe is finding it difficult to recruit this number of employees in the local area required. Prepare extracts of statement of financial position and statement of profit or loss of Gbogbo Nishe Enterprises for the year ended June 30th, 2019, using the two methods of presenting grants in the financial statement of the business head. Okay, so we are asked to present an extract of these statements using the two methods. So let me start with the first. So we're going to use two methods depending on whether it's a grant related to asset or grant related to income, right? So let's look at each of these grants. The first one, they gave him a grant of 1 million and it was in respect of training. So that first one, this first one is a grant related to income because it has nothing to do with related to assets. So here now, the method one for grant related to income is either you present it as a separate line item in PL, and method two is you net off against the related cost of, I think they give us related cost. Yes, 1.75. This one doesn't really 1.75 million in pure. This one does not require any workings. We will show it in our statement when we are preparing our statement like that. So the second one, so let me put in brackets, this grant received for training. So the second one, so on November 2018, Gbogbo Nishe Enterprises acquired plant costing this, and he received a grant from CBN in respect of the purchase. So this is a grant related to assets, clearly. And for this one, which is method one, which is to deduct a grant from the cost of the assets. In this case now, the cost of the assets or the cost of the plant becomes how much?
8.75 million.
Okay, 8.75 million minus 2.5 million. Where would that leave us? Or let me do it like this so it's clearer. Let me just put it in thousands like this. So if I deduct it,
6,250,000.
so this is the cost of the. So in this case now, it will impact our depreciation per annum, which will now be 6,250,000. What's the useful life of these assets? 5 years. 5 years. I think there was a.
So it's 1,250,000. Okay.
Yeah, there was a residual value. There's a residual value of 1,250. So I need to expand this. And also, which most students will omit, is that the asset was actually acquired in November and the year end is June. That means you have to prorate it. You cannot do full year depreciation. But whatever you get from November, that's how many
Over
months?
12.
Times what?
7/12. 7/12.
Okay, let me confirm. November, December, January, February, March, April, May, June. No, it's 8. It's 8. It's 8/12.
Okay, I thought it's November 31st. So sorry for that.
Okay. So what's our depreciation per annum for that year?
$667.
667. So what's the carrying amount of these assets in this case?
$5,583. 5,583.3.
Okay.
5,583.
Okay, 5,583. So this, if you are using method 1, where you deduct the grant from the cost of the assets. But if I decide to use method 2, where I deduct the grant, where I set up the grant as a deferred income. In that case, the cost of my asset, the cost of the plant will not change. It's still the 8,750. It won't change. But my depreciation per annum becomes 8,750 minus 1,250 minus 1,250 divided by what? 5 multiplied by 8/12. How would that give us?
1,000.
1,000. So what's my carrying amount in this case?
7,750.
7,750. So, however, in P&L, so the grant income will be recognized, or the grant received will be recognized over how many years? Over 5 years. So in year one, so grant income in year one would be 2.5 million. $2.5 million divided by 5 years. A lot of people will forget to prorate this one too. They might just do divided by 5. You're supposed to prorate it. Because
So that's 333.3.
okay, let's approximate.
Okay.
Then we'll have a deferred income of how much? How much will go to deferred income?
2,167 naira.
Okay, that's the two method. Method 1 and method 2. The third one, in June 2019, we got a grant from CBN also. And this grant was in respect of relocation costs. Okay, so that means this is a grant related to income. It's a grant received for relocation. So now that we have incurred for movement of his business to a free trade zone allocated to MSMEs, they told us that the grant is repayable in full unless Gbogbo Nishe recruits at least 100 employees from the free trade zone by the end of the month of June 2019. So Gbogbo Nishe is finding it difficult to recruit this number of employees. Oh, okay. So what we would do is this. For this one, you cannot, there's not even any method here. So since the entity is finding it, let me just put it the way they put it in the question, is finding it difficult to meet the condition attached to the grant. It should recognize the grant as a deferred income, no, as a liability, which is deferred income. Because just to get ready, you should not even put it to P&L at all, in case they ask him to return it. So let's prepare our statement using method 1 and method 2. So method 1, my statement of profit or loss, method 1, the first one, if I'm presenting it as a separate line item, how much did they give him? 1 million. So grants received, 1 million. Those training costs on 750. That's this one, method 1. For method 1 here, I will recognize depreciation of 667. On the second grant, that's the method 1 here. Depreciation of 667, that's the only thing that goes to P&L. And there's no method 1 here. This is going to statement of financial position. And in my statement of financial position, under my non-current assets, I'll have my plants. Under method 1, there's nothing going to statement of financial position here for the first grant. For the second grant, my carrying amount is 5583. 5583. And also, I will have a current liability. Let me call it so that you know, sort of as a grant repayment. Let me just call it grant repayment so you know that something is supposed to repay. Now, method 2. In my statement of profit or loss, under method 2, for the first grant, I will net it off against 1.75. So we are not presenting the grant as a separate line item, but netting it off against this 1,750. So that the balance you have is just 750 as training costs. That's method 2 for the first grant. Method 2 for the second grant, which is this method 2, we will recognize depreciation of 1 million here. Depreciation 1 million. Still on method 2, having recognized depreciation of 1 million, we're going to recognize grants of 333. So we have grant income of 333. And that is all for P&L. In my statement of financial position, under my non-current assets, I have my plants. My plants, what was the carrying amount? It was 7750. Plant is 7750. And under non-current liabilities, there is a deferred income. This deferred income here, the balance here, 2167. Under current liabilities, this one, this repayment of government grants. So to be there too. And that's the end of this question, and that's the end of this standard. Do you have any questions? Okay. So the only one left is IAS 20. But I'm not ready to take that. I'm not mentally ready to take that. So this is the only thing left that we did not cover based on our plan. And today is the final extra class for the combined class that I'm combining the two of you. So from next weekend, case study would happen from 8 to 10 o'clock. I think for my FL students, that our evening class on Sunday, it would have to happen from 10 to 12 in the morning on Sundays for the remaining period we have for the exam, so that we won't have the evening class anymore. I think it's better for us so that, I mean, we are going to discuss it later today when we meet in the evening. So for now, have a wonderful Sunday and enjoy your day. Bye.
Thank you, sir.
You're welcome.